If you're a dividend investor, you're going to love these three Dividend Kings that I'll be analyzing today. A Dividend King is a company that has been consistently growing their dividend for the last 50 years. Now, two of these that I'll be sharing today, I have in my personal portfolio, and I'll be sharing what price target I look at when I'm adding them to my portfolio. And the first one I'm going over has just announced that they're increasing their dividend for the 61st year. So let's jump in. And if you're here analyzing stocks to help you on the investing journey. Now, the first company on their list is in the healthcare sector, and they just announced their Q1 earnings. This company is Johnson & Johnson, ticker symbol J&J. Now, Johnson & Johnson beat their earnings per share by 18 cents, and they also beat their revenue by $1.09 billion, which is great to see. And Johnson & Johnson has three different segments, which are consumer health, pharmaceuticals, and medtech. So looking right here, you can see that each of these three sectors, they have grown within this last quarter. Since the beginning of the year, Johnson & Johnson has fallen 8.7%. However, within the last month, Johnson & Johnson has grown 6.5%, bringing it to a current share price of $162.69. Now, a few months ago, Johnson & Johnson was at its 52-week low of $150, and right now they are moving close to their midpoint of their 52-week range. Now, if you have seen my other dividend portfolio updates, you know that when Johnson & Johnson was close to its 52-week low, I've been picking up some of the shares. So it was very nice to see when it dropped there. Now they have a PE value of 15.27, and they currently have a forward dividend yield of 2.93%, which will give you an annual payout of $4.75. Now, speaking of their dividend, they just announced that they will be increasing it for the 61st year by 5.3%. So recently it was $1.13. And right now you will receive $1.19 per share every quarter. So that's great for us dividend investors. Now, Johnson & Johnson pays $11.5 billion in dividends, and their current free cash flow is $17.18 billion. So they definitely have enough free cash flow to pay those dividends to investors. Looking at its market cap, we have $425 billion. And looking down here at this enterprise value, it is $512 billion. So the difference between the market cap and the enterprise value will give you the debt that's within the company. Now, one thing that is nice to see is that their gross margin is 67%. The gross margin is that for every dollar that it sells, it receives this much profit before taxes and overhead. It's very nice to see a large gross margin. And also good to see that its profit margin is pretty consistent within the last 5 years. One other thing I want to look at is its return on invested capital, ORIC. You see right here, it has been consistent within the last 5 years. Now, return on invested capital, the ORIC, shows that a company can have a higher profit with investing less money into it, and also can show that it has a moat. So it's good to see a company with higher ORIC. You pay a little more premium for it. Looking over here on its income statement, we can see the last couple of years that Johnson & Johnson has been increasing their revenue year over year with a nice bump up after 2020, which is great to see. Scrolling down here to its net income, has dropped a little bit from last year, but looking here, it's starting to get back into line of what it had previous to COVID. Right down here, you can see earnings per share, and our earnings per share did drop a little bit from its previous year, but it's going back in line what it had prior to 2020. And they are buying back shares, which is great to see, especially since they were close to their 52-week low the last couple of months. And you can see here that during COVID, they were keeping consistently, and now it's starting to buy back shares again. So nice to see. And then right down here, the dividend per share has been growing year over year, which is great to see as well. Earlier I did mention their free cash flow, having enough to pay those dividends and also buy back shares. And we did drop a little bit from last year, but it's going back close to what it's had previously. And the 5-year average is $19.12 billion. So definitely have a good amount right there staying consistently. Now, Wall Street analysts do consider Johnson & Johnson as buy right now with a high of $215 and a low of $161, which is where the current share price is. And they have an average of $178, which is about close to a 10% upside from its current share price. Now, looking at some analyst estimates, you can see right here that they are projecting earnings per share growth within the next about 5 years. So you can see right here their estimates. And down here, as far as revenue, they are also estimating growth as well within the next 5 years. You can see right here. But also take these estimates just with a grain of salt, but a nice ballpark to kind of look at to see what others are looking at for the company. Over in the stock analyzer for Johnson & Johnson, for the revenue growth, since it is a large company, it's going to have slower growth than other companies in the pharmaceutical realm. So I put 1, 2, and 3%. For profit margin, I put 17, 18, 19%. For free cash flow margin, I put 18, 20, and 22%. And then for price to earnings and price to free cash flow, I put 14, 16, and 18% and a 10% return. So scroll down here, you can see that based on these assumptions, the current share price is above these assumptions right here. Now for me personally, I'm looking at a price target under $150 just so I can start dollar cost averaging down. And we did hit that $150 a couple months ago, as I mentioned before. So I do think a good range for Johnson & Johnson is below that $150 in the low 100s, as you see right here. Looking at a weekly view right here, you can see the last couple weeks, it has moved away from its 52-week low through all of its moving averages, hitting its 50-day moving average. So we are starting to get a little positive momentum, but it's still on the bearish side. So we are moving sideways, and you can see here with the yellow trend, we are in a neutral trend and in the oversold section. As for a daily view, we can see the last week or so it's been bouncing between its 50-day moving average and its 200-day moving average. We are starting to pick up some positive momentum right here, and we are still in a neutral trend. So it's going to take a lot of energy to possibly move through its 200-day moving average and making new highs. If we stay in this neutral trend, most likely we'll be bouncing between $160 and $165 range. Next company on the list is in the consumer staples sector and also has a high dividend yield of over 8%. This company is Altria Group, ticker symbol MO. With this company, many investors have like a love-hate relationship being in the tobacco industry. Personally, I don't have it in my portfolio because of the industry that it's in, but many investors flock to it with its high dividend yield. Now, I'd like to point out that at the beginning of March, Altria Group did just finish its acquisition of Enjoy Holdings, which will further increase some revenue that the company will be receiving. From the beginning year, Altria Group has grown 1.38%. However, within this last month, it has fallen about 0.5%, bringing it to a current share price of $46.15. Now, Altria Group is right below its midpoint, moving away from a 52-week low of $40 with the high of $57. It has a PE of 9.14, and as I mentioned, a nice high dividend yield of 8.15%, which will give you a nice annual payout of $3.76. Every year, Altria Group pays out $6.6 billion in dividends, and looking at their free cash flow of $8 billion, they can definitely afford that dividend yield. As far as its market cap, it has $82 billion, and looking at its enterprise value right in here of $119.5 billion, so it has a lot of debt within this company. So just keep that in mind. One good thing to see is it does have a high gross margin of almost 69%. And looking at its profit margin, this last year it had a big jump from the previous 5 years. Also on its OROIC, this last year it has a nice high OROIC percentage. It is a big jump up from what it's had the last 5 years. But as far company-wise, it's good to see that high ROIC. Over on the income statement, looking at its revenue, it's been staying pretty consistent around that $20 billion range. And scroll down here to its net income, it has jumped up from its previous year. But also at Altria Group, there's been some up and downs, as you can see right here, through the last couple of years. And as far as earnings per share, pretty similar to its net income. We do have a spike up from last year, and it's been fluctuating the last couple of years. So definitely want to keep that in mind. Buying back shares, it has been buying back shares consistently over the last couple of years, and it has been growing its dividend consistently, which is great to see. Now, similar to its revenue, its free cash flow has stayed consistent around that $8 billion range. And that leaves it a 5-year average of $8 billion. So they'll definitely have enough to continue paying that dividend yield. As far as Wall Street analysts, they are considering Altria Group as a hold right now, with a low of $37 and a high of $70, with an average of $49, which will give you about a 7 to 8% upside from its current share price. Analysts do estimate that Altria Group will grow its earnings per share over the last about 5 years, as you can see right here. And as far as its revenue growth, they also see Altria Group growing its revenue over the next 5 years, as you can see right here. Now, as far as my assumptions for Altria Group, looking at its revenue growth, I have 0.5%, 1%, and 1.5%. Profit margin, I have 18, 22, and 26. Free cash flow margin, I have 28, 31, and 34%. For its PE and price of free cash flow, I have 12, 14, and 16 with 10% return. Scroll down here, looking between my mid and high, we are right in between those two values. So based on my estimates above, I think the low 40s is a good price range for Ultra Group if you don't mind being in the tobacco industry realm. Over on a weekly chart, Ultra Group has been back and forth around its 50-day moving average and not being able to break through its 200-day moving average, which is this white line right here. It still has bearish momentum, so not a lot of change right there, and it's in a neutral trend here close to its oversold section. On daily view, the last few weeks it has broken through all of its moving averages and did have a little jump up from its 200-day moving average. We still have bearish momentum, but it's starting to move in that direction and do have a neutral trend here, getting close to its overbought section. As for me, I think with not enough momentum right here, it's most likely staying in the low 400s right here, not having enough energy to get to that $50 range and most likely stay around $45. If you've been getting value out of this content, let me know by smashing the like button. Helps grow the channel and spread the video to other investors such as yourself. Next company on our list is in the consumer discretionary sector. This company is Lowe's, ticker symbol LOW. Now I do have Lowe's in my current portfolio and I wanted to compare it to Home Depot and S&P 500. So looking right here, we have orange is Lowe's, then we have blue for S&P 500 and purple for Home Depot. So within the last year, Lowe's has outperformed both of those with about 3%, while the other two have been in a negative. As we just saw within the last year, Lowe's has grown about 3%, and within the last month, it has grown close to 7%, bringing it to a current share price of $211.04. Now Lowe's is moving close to their 52-week high, which was $223, and does have a PE value of 15.37. They have a decent dividend yield of 1.99%, which will give you an annual payout of $4.20. Last year, Lowe's has paid $2.5 billion in dividends, and it has a free cash flow of $5.8 billion, so it definitely can support that dividend that it pays out every year. For a market cap, it has $126 billion compared to its enterprise value of $182 billion, so has some debt right now, and has a nice gross margin of 33%, and the profit margin has dropped a little bit this last year compared to its last 5 years. As far as its return on capital, has a very nice one of 90%, a nice jump from its last 5 years. Over on its income statement, since 2020, Lowe's has really spiked up into the $90 billion range, coming off of what it previously had around the $78 billion range. So it is nice for Lowe's staying consistent with this nice jump up from 2020. Scrolling on here to its net income. This last year, the net income has dropped a bit, getting back in line of what it had previous to 2020. And as far as its earnings per share, it has also dropped since last year, come back to a range it had prior to 2020. Now, as you see right here, Lowe's has been buying a good amount of shares over the last year, which is good to see when it was dropping close to its 52-week range. And Lowe's has been growing its dividend year over year. This value right here is a little skewed for this year, but it has been growing year over year, being that dividend king. As far as its free cash flow, it has dropped a little bit this last year, moving back in line of what it had previous to 2020, so that's understandable, and it has a nice 5-year average of $6 billion. Wall Street analysts are considering the Lowe's as a buy right now, with a low of $151 and a high of $300, with an average of $228 billion, which is about 8% upside from its current share price. Analysts are estimating growth for Lowe's over the next 5 or so years, going from $13 to $23. And scroll down here, we can see that as far as revenue, analysts are estimating a nice growth here as well. As you see right here, $98 to $103 billion. For my assumptions of Lowe's, looking at revenue growth, I have 1, 3, and 5%. For profit margin, I have 3.5, 4.5, and 5.5. Free cash flow margin, I have 5, 6, and 7%. And for PE and price free cash flow, I have 16, 18, 20 with a 10% return. Scroll down here, we can see that the current share price is between my mid and high. Personally, I'm looking at under $200. That's where my current average is right now. So when it was below $200, I've been adding some to my position. But I think under 200 is a good price range for Lowe's right now. Within the last month, Lowe's has stayed above its 200-day moving average and has moved through all of its other moving averages. We are on the bearish side of the momentum, but it has been staying in a positive direction. And right now we are in a neutral trend, coming close to its oversold section. On the day chart, we can see that it has been staying around that $200 range and just started to move above that, close to its 52-week high. We are starting to see a nice increase of its momentum. We're still in a neutral trend right here, but starting to move to an overbought section. So it doesn't get enough momentum right now. It's most likely going to stay in the low 200 range. There you have it, 3 great Dividend Kings to add to your portfolio, which are Johnson & Johnson, Ultra Group, and Lowe's. Let me know down in the comments if you have any of these on your watch list or in your portfolio. And if you're looking for more stock analysis, check out this video right over here. I'll catch you over there. Have a blessed day. Peace.